If you have spent any meaningful amount of time in the markets, then there is a very specific moment that you probably experienced more than once. It's the moment when you take a trade that you already know you should not be taking. You're looking at the chart and something inside you is telling you that the setup is quite not right. The conditions you defined earlier are not fully there. The entry is not exactly what your system requires. But despite knowing that, despite all that hesitation, you still click the button. A few minutes later, the trade starts moving against you. And suddenly, you are sitting there wondering the same question that traders around the world ask themselves almost every day. Why did I take that trade? Most traders believe the problem must be technical. They assume that the strategy is a problem. Maybe they believe they have not learned the right model yet. Maybe they think they need a better indicator or a better entry technique. So they start searching. They watch hours of content. They watch hours of YouTube videos about technical strategies. And every few weeks, they convince themselves that they have found the missing piece. Now, for a short period of time, they feel optimistic. They feel motivated. They believe this new approach will finally change their results. But after enough time passes, something uncomfortable starts revealing itself. Despite learning more strategies, despite understanding the charts better than they did before, their behavior does not change. They still take trades that were never part of their plan. They still chase movements they know they should ignore. They still break the rules that they themselves created, and eventually a difficult realization starts forming in the background of their mind. The problem was never the strategy. The problem was impulse. Impulse trading is one of the most dangerous habits in the entire trading profession. And the reason it is so dangerous is because it does not feel like a mistake in the moment. When traders make impulsive decisions, their brain immediately produces logical explanation to justify those decisions. The reasoning sounds convincing. The trader feels confident enough to press the button. But underneath that confidence, something much deeper happening psychologically. This lecture is not about any chart patterns or indicators. It's about the internal battle that every trader faces once they sit in front of the screen. Because trading is not just a technical skill. It's a psychological environment that constantly tests your ability to control your own behavior. The market does not force you to act. The market does not push your mouse. Every trade that you take is a decision that originates inside your own mind. And that is where the real challenge begins. Because once the market starts moving, once the candle starts to form, once the momentum is there, your brain begins to react in ways that you may not even realize. Thoughts begin appearing that were never there before. Emotions begin influencing decisions that were supposed to be purely mechanical. And slowly, without noticing it at first, your behavior starts drifting away from the plan that you created before the session began. Understanding that process is the first step toward solving it, because impulse trading is not random behavior. It follows a very predictable psychological pattern. And once you recognize the pattern, you begin to see how one small decision can eventually grow into a much larger problem. The first impulse trade often feels harmless. But what most traders do not realize is that it frequently becomes a starting point of a chain reaction that often leads to overtrading, emotional decision making, and eventually a state where discipline completely disappears. Now, to understand why that happens, we first need to define what impulse trading actually is. When people hear the phrase impulse trading, they often imagine chaotic behavior. They picture someone clicking the buy and sell button without any thought behind their decisions. But in reality, impulse trading rarely feels random to the person doing it. In fact, most impulsive traders feel justified in the moment they are taken. That is precisely what makes this habit so hard to eliminate. Imagine sitting in front of your chart at the start of a trading session. You have already done your analysis. You have marked important levels on the chart. You know exactly what conditions to look for before entering the market. Your plans are clear and your rules are simple. You have decided that you'll only take one trade if price reaches your level and confirms the setup you're looking for. Until that happens, you promised yourself that you'll remain patient. At the beginning, everything feels easy. Price is moving slowly and there is particularly nothing interesting on the charts. Waiting does not feel difficult because there is nothing to tempt you. But after some times, the environment starts changing. A strong candle forms, then another one forms immediately afterward. Momentum starts building and the chart suddenly looks more active. At that moment, a small thought appears behind the back of your mind. It might be something as simple as, this might be the move. You continue watching the movement develops. The candles look strong and the price seems to be accelerating. Another thought appears. Maybe I should enter now before it goes too far. At this stage, your brain starts shifting from your analysis mode to reaction mode. Instead of evaluating the market according to the rules you created earlier, your mind begins responding to what it sees happening in real time. Now, something happens interesting psychologically. Your brain begins generating logical explanation for why you should enter the trade now. You might tell yourself that the momentum looks good. You might convince yourself that the breakout looks cleaner. You might believe that the movement could continue moving further much if you do not act quickly. All of these thoughts sounds logical when they appear in your mind. But if you take a step back and examine the situation calmly, you realize something important. None of those reasons were part of your plan. Your system did not say to enter just because the candle looks strong. Your strategy did not say to enter just because the movement felt exciting. Your plan had specific conditions that needed to appear before you were supposed to act. But in that moment, those rules felt less important than the movement happening on the screen. Eventually, the tension between waiting and acting becomes so comfortable that you end up clicking the button. For a brief moment after entering the trade, there is a sense of relief. Taking actions removes psychological pressure that comes because of waiting. The uncertainty disappears because you have taken a decision, but that relief does not last very long. Within few minutes, the trade might stall or reverse or simply fail to behave the way you expected. At that moment, you begin realizing something uncomfortable. The trade you just took was never part of your system. That realization creates one of the most frustrating feelings a trader can ever experience, because the loss did not come from misunderstanding the market. It came from ignoring rules that you created yourself. And when that behavior repeats itself over and over again, it slowly erodes the discipline that every successful trading approach depends on. But impulse trading does not appear out of nowhere. There is a deeper reason your brain behaves this way. To understand why impulse trading happens so frequently, you have to look beyond trading itself and consider how the human brain evolved. This decision-making system inside our mind were not designed for financial markets. They were designed for survival in a very different environment. For thousands of years, humans survived by responding quickly to opportunities and threats in their surroundings. If only humans saw food, they needed to react immediately before the opportunity disappeared. If they sensed danger, they needed to act quickly to protect themselves. In those environments, hesitation could be costly. Quick reactions often meant the difference between survival and failure. Because of that history, human brain developed strong instinct that encourage immediate action whenever something appears significant. The problem is that financial market operates under completely different conditions. In trading, reacting quickly is rarely the skill that produces consistent profits. Instead, success often comes from patience, discipline, and the ability to wait for certain conditions before reacting to it. Unfortunately, the brain does not naturally enjoy waiting. When nothing is happening on the chart, the mind becomes restless. It begins searching for stimulation. It begins interpreting small movements as potential opportunities. Over time, the discomfort of inactivity becomes stronger than the discipline required to be patient. And this is the point where impulse trading begins. The trader is not responding to a carefully analyzed setup. The trader is reacting to the psychological discomfort created by waiting too long. In other words, the trade is not being driven by strategy. It is being driven by the brain's desire to relieve discomfort or tension. This dynamic explains why traders who sit in front of their charts most of the time for a longer period are the one most vulnerable to impulsive decision. The longer someone watches the market without seeing a setup form, the stronger the urge becomes to interpret ordinary price movement as meaningful signals. Eventually, the brain convinces itself that action is necessary, even when the original plan stated that no trade should be taken. Understanding this psychological pressure is important because it reveals something important about trading. It reveals a critical truth about trading. The biggest challenge is not learning how the markets move. The biggest challenge is learning how to manage your own behavior while observing those movements. And once impulse trading begins, it often leads to another bigger problem that many traders experience. Now, impulse trading rarely remains an isolated event. More often, it becomes the beginning of a chain reaction that leads to overtrading. To better understand this, imagine a trader who starts the day with a clear plan. The trader has decided to take no more than 2 trades during the session, and each trade will raise small percentage of the account. The first trade of the day is taken impulsively and ends in a loss. At first, that trader feels slightly frustrated, but the situation still appears manageable. Losses are a normal part of trading, and one mistake does not seem like a major problem. The trader then tells himself that the next trade will follow the rules more carefully. However, the emotion of the first loss started influencing that trader's mind. Instead of waiting patiently for the next valid setup, the trader begins scanning the chart more aggressively, looking for a quick opportunity to recover the loss. When a potential trade appears, the trader quickly jumps in that trade even though the setup wasn't clear at all, and the second trade also fails. Now, the psychological pressure becomes more stronger and the trader starts feeling urgency. The original plan of taking 2 trades today starts to feel restrictive. The trader starts thinking that one more trade can easily recover the previous loss. But the third one, also influenced by emotions rather than discipline. As this cycle continues, the trader who convinced himself that today he's not gonna take more than 2 trades may end up taking 10 or 12 trades. Each additional trade feels an attempt to solve the problem that had been created with the previous trade. But instead of solving the problem, each new trade increases more emotional pressure and reduces the quality of decision making. Overtrading is not usually caused by abundance of high quality opportunities in the market. It is caused by the psychological need to remain in control caused by a mistake. And once that becomes strong enough, discipline starts fading, and the trader starts entering a more dangerous mental stage. One of the most destructive psychological conditions a trader can experience is commonly referred to as tilt. The term originally became popular in competitive gaming and poker, but the concept applies perfectly for trading as well. Tilt describes a mental state where emotional pressure and frustration becomes so stronger that rational decision making begin to disappear. A trader entering tilt state usually begins with a series of losses or mistakes. At first, the trader tries to remain calm and remind himself that losses are a normal part of trading. But as the losses accumulate, the emotional impact becomes harder to ignore. Confidence begins fading and frustration starts building beneath the surface. Eventually, the trader stops focusing on the strategy and starts focusing on recovering the lost money as quickly as possible. This shift in motivation changes the entire decision-making process. Instead of evaluating trades according to the rules of the system, the trader begins looking for any opportunity that might produce a quick win. Risk management often disappears during this phase. Position sizing may increase dramatically because the trader believes that one large win could erase all the previous losses. Entries become careless and confirmation signals are ignored. The trader is no longer operating with discipline and patience. Now he is operating under emotional pressure. In extreme cases, tilt can lead to catastrophic outcomes within a very short period of time. A trader who spent months building an account can lose a significant portion of that account in a single afternoon, simply because emotional decisions replace structured ones. But tilt is not the only psychological trigger that produces impulsive behavior. There is another force traders experience frequently when markets begin moving quickly: fear of missing out, commonly referred as FOMO, is one of the most powerful emotional drivers in trading. It appears when traders observe strong movement in the market that they were not initially part of. The chart begins showing large candles and the momentum increases quickly. The trader watches the movement unfold and begins thinking about the profit that could have been made if the trade had been taken earlier. This thought quickly creates a sense of urgency. The trader begins feeling that an important opportunity is slipping away, even though the movement may be already extended and the probability of pullback increasing. The emotional pressure created by FOMO pushes the trader entering the market anyway. Chasing trades under these conditions often leads to poor entries because the trader is entering the markets when the majority of the movement has already occurred. When the inevitable movement happens, the trader finds himself at one of the worst possible prices. This creates frustration and often leads to overtrading and tilt behaviors described earlier. Professional trader eventually learns to recognize FOMO as a psychological illusion. Markets produce opportunity every single day. Missing one movement does not eliminate future possibilities. But until a trader develops the discipline to accept missed opportunities calmly, the pressure created by FOMO can repeatedly lead to impulsive decision. The most important lesson in trading is rarely about technical analysis. It's about self-control. Markets operate according to supply and demand, and those forces will continue moving whether an individual trader participates or not. The market does not care about personal expectations, emotional reaction, or financial goals. What determines long-term success is not the ability to predict every movement correctly. It is the ability to follow a structured process even when emotions are present. Traders who learn to control their impulses gradually begin taking fewer trades, but those fewer trades tend to be higher quality and better aligned with their strategy. Over time, discipline begins replacing reaction, decisions become clearer, and the overall trading experience becomes more stable. The market itself has not changed, but the trader's relationship with the market has now evolved. Alright, I hope you guys enjoyed this video. Make sure to give a thumbs up and sub up to the channel, and I'll try to bring more content like this on this channel. And until then, follow the rules and become better 1% every day. Stay safe, stay healthy, and good trading and good life to y'all.